How's it going, everybody? It's Stas here. So in this video, we're going to be talking about 3 ETFs to buy right now as a beginner in the stock market. If you're just getting your toes wet, just starting out in the stock market here in 2020. And the funny thing is, a lot of people ask me, especially beginners, how do I get started in the stock market? Do I buy penny stocks? Do I buy high-flying speculative growth stocks? Do I buy individual blue chip stocks? And the truth is, guys, the best way to get started, at least in my opinion, to get your toes wet is by buying index funds, or even better, in my opinion, exchange-traded funds, also known as ETFs. So first and foremost, what is an ETF? An ETF is a type of security, and this is straight from Investopedia, great source out there. It's a type of security that involves a collection of securities, such as stocks, that often track an underlying index. And the beautiful thing about ETFs is, again, they track underlying indexes and they trade like stocks, meaning you can buy them Monday through Friday whenever the stock market is open between 9:30 a.m. Eastern Standard to 4 p.m. Eastern Standard, and they're super liquid. You can buy in, you can sell out, you can jump into other ones, but the truth is they're not meant to be traded like that, but the idea that you can just sell out and liquidate your money at the snap of a finger is very attractive, and that's kind of what ETFs provide you with. And before we even get into the 3 here, and I'll add a couple bonus ones at the end if you guys stick till the end, all I ask from you is if you guys find value in the video, hit that like button for me, consider subscribing to the channel, and check out all the free links down below in the description box if you want to join our Discord chat, Facebook group. Both of those are free of charge. And if you want 2 free stocks, and if you're a beginner, this is great to kick off your investing journey with some free money. Check out the link down below from Webull. The 2 free stocks are actually valued up to $1,400. All you have to do is deposit $100 into the platform, and that is when you get your free money. And let's get right into it. Now that we covered what an ETF is, let's talk about what are these 3 ETFs and the bonus ones at the end right now. So the first one here is SPY. And let me pull up my ThinkOrSwim so you guys get a look at what this ETF looks like and how it's done over, let's say, 3 years, 10 years, 20 years, etc. This is the performance of this ETF. And for those of you guys that are wondering what this is, it tracks the S&P 500 index. That's it. This is simply an ETF that tracks the S&P 500, and the S&P 500 comprises the 500 largest publicly traded companies here in the United States. So if you want a piece of that pie, SPY is very good. And to dive deeper into this ETF, let's go into Safari and take a look at this. And this shows you the different holdings that the ETF has, the different ratios. Well, not really. Well, it does show ratios, but actually the expense ratio, which is big, a bunch of other ratios as well. And when it comes to actually analyzing ETFs, the basic things that I do is I look at the different holdings the ETF has, how it's diversified between different sectors, which we'll get into here in a little bit, and what is the ratio and the dividend yield, of course. So for this one, S&P 500 ETF, the dividend yield is around 1.8%. Pretty solid there. You can pretty much get that from any website, Yahoo Finance, Seeking Alpha, this website right here. And the expense ratio is 0.09%. And you're asking yourself, Stas, what is an expense ratio? Well, these funds need to be managed by somebody, right? And whoever's managing them, that's who gets paid the expense ratio, which pretty much comes out annually for the most part out of your account, out of your cash, right, or out of your position. And in this case, if you have $1,000 in SPY, they're taking a very minuscule amount out. I mean, less than 0.1%. Literally, guys, it's 1/10 of 1%. So out of $1,000, they're taking out less than $1. It's about 10 cents. I mean, that is really nothing for managing this ETF. And you notice some mutual funds out there, they have expense ratios of 1%, 2%. So you're getting a fund here for a lot less than what a lot of these mutual funds cost. So let's go over here to holdings to break it down. So this one, you can see it here. Its top 10 holdings are Apple, Microsoft, Amazon, Facebook, Alphabet, Class A and Class C shares here, Johnson & Johnson, Berkshire Hathaway, Visa, and Procter & Gamble. And the top yeah, that's pretty much it. And you can actually look deeper if you want to see all of the different holdings, but it's pretty much just the S&P 500, right? And the way it's broken down between sectors is 26% IT information technology, 14% healthcare, 11% consumer discretionary, 11% communication services, 10% financials, and the list goes on, right? But it's heavily invested in information technology because you guys know this. The biggest companies in the S&P 500 are tech stocks, and they make a lot of the S&P 500. So this is one way a beginner can get their toes wet when it comes down to just generally investing out there in the stock market. If they're just starting out, they have no idea what to do, this is a great way to own some of the best businesses in the United States and in the world in general. So that's the first one here, SPY, and the second one is VTI. Remember, SPY is the S&P 500, but VTI is actually the total stock market index. So this holds a lot more stocks other than the S&P 500 stocks. It has a lot of mid-cap. I mean, you guys can see it here in the product summary. It has large, mid, and small cap equity diversified across growth and value styles. It employs a passively managed index sampling strategy, very similar to the S&P. It's very passive. You add money into it every month, every week, bi-weekly, however it works for you. And the idea is to hold it for the long term, right, and benefit from the growth of all of these different companies. And when it comes down to the dividend yield of this one, and you guys can see, it actually has 3,500 holdings. So S&P 500's 500, roughly 510, I think the SPY has. But this one has 3,500. So you're getting even more diversification. And the dividend yield right now in VTI is roughly 1.7%. You guys can see it here, 30-day SEC yield as of 6/30/2020. So that's pretty good there, 1.7%. And the expense ratio is actually even lower than SPY. It's actually 0.03%. So for every $1,000, guys, think about this. For every $1,000, you're giving away 3 cents, if I'm not butchering that math. I do think that is, wait, is it 3 cents? For every $100, it might be 3 cents. Either way, you're not paying much at all when it comes to the expense ratio at 0.03%. Again, some of these mutual funds have 1-2%, which over the long term, that eats into your gains like crazy. But 0.03%, it's not really going to do much damage unless you're moving billions of bucks like Warren Buffett or somebody like that, Elon Musk or something, who knows. But if you're just an average Joe, 0.03% is not much whatsoever. And when we're breaking down, what sectors this is broken into, we have the top in technology, very similar to SPY, 26%. Financials is second at 16% of the ETF here. Consumer services is third at 14%. Then we have healthcare at a close fourth, also at 14%. And then we have industrials, and the list goes on. So this one's heavy in technology, financials, healthcare, and consumer services. And the top 10 holdings, guys, the truth is, it's not going to differ much between VTI and the S&P 500 ETF because the top holdings are the same. I mean, it goes by pretty much, a lot of the time it holds the biggest companies out there, and they're the same across the board for the most part, right? We have Microsoft here at number 1, Apple at number 2, Amazon at number 3, Alphabet at number 4, which is Google, and Facebook at 5, J&J at 6, Berkshire at 7, Visa at 8, Procter & Gamble at 9, and United Health Group at 10. 10. So that is VTI. This grabs a lot of diversification. Again, 3,500 holdings in this ETF. That's unbelievable. And the net total assets are $870 billion. So this is a massive fund. And going back here to the SPY to see their assets under management, it's right around $260 billion. So the third ETF here is going to give you a bit of exposure to some developed markets outside of the United States. The truth is, guys, you don't want to be too aggressive in one country. You do want to have, especially in this environment, you do want to have some investments, and I'm not a financial advisor, guys, again, do your own due diligence, but you do want to have some investments outside of the United States. So this is an ETF that I personally own and that I love and I continue adding to. It is VEA. It's also known as the Vanguard FTSE Developed Markets ETF. And you may be asking yourself, Stas, isn't the United States a developed market? Is the United States included in this ETF? And the truth is, it's not. This is an ETF that has developed markets outside of the U.S., excluding the U.S., which is why in the product summary here it says, seeks to track the investment performance of the FTSE Developed All Cap ex-U.S. Index. So this provides a convenient way to match the performance of a diversified group of stocks, large, mid, and small cap. And a lot of these companies are located in Canada, Europe, and the Pacific region. A lot in Asia, a lot in Canada, and a lot in Europe. So when we're looking at this, expense ratio is 0.05%, pretty much nothing there. Very similar to SPY and VTI. And looking at the fund, we can see a lot of the companies that it owns. It owns Nestle, Roche Holdings, Samsung, Novartis, SAP. It owns Toyota, ASML, AstraZeneca, Unilever, Royal Dutch. A lot of these companies, you won't know them, but a lot of them, you will know them, right? I personally know some of these. I know Samsung, SAP, Toyota, Unilever, Royal Dutch, Nestle, and some of these, again, that you won't know. Some of them I don't even know. But the truth is, you're not supposed to know all of them. There's thousands of stocks in the ETF, and you're not going to know all of them. The idea is to just buy this for diversification, again, like we've been saying. And this owns nearly 4,000 stocks, which is absolutely unbelievable. And the truth is, guys, again, you have to be diversified in many different areas. I love owning stocks in Europe, in Asia, in Canada, and in the United States. And I'll be honest, a lot of the stocks that I own in the United States, not to get off topic here, they also do a lot of business outside of the United States, which you'll realize, some of the stocks within the total stock market ETF and the SPY ETF, a lot of these stocks, they already have international exposure, like I just said, right? So VEA is definitely one to keep an eye out on if you want some exposure outside of the United States, right? Again, in Asia, in Canada, you guys can see it here, 52% of the fund is in Europe, 38% Pacific, and 8% up in Canada there. And some bonus ones here that I want to go over. And before I forget, the dividend yield on VEA is pretty nice as well, 2.7%. And some bonus ones here that are a bit more risky, but you want to have some exposure to this eventually as a beginner, is some mid-cap and some small-cap ETFs. The ones that we just talked about, they're all large-cap companies for the most part. Large-cap, billions of dollars of companies here. But a lot of the mid-cap, small-cap are smaller companies. So one to keep an eye out here is VOT, which is a mid-cap Vanguard growth ETF, 0.07% expense ratio. And I'm not sure if this one has a dividend. Probably not. Oh, it does. 0.7% dividend. But the truth is, you're not investing in this for the dividend. You're investing in it for growth, right? For longer term growth. out of these mid-cap companies, which is what we can expect. 30% of the ETF is in technology, 18% in industrial, 17% in financials, and these are some of the top companies here. And the last bonus one is Vtwo, which is a small cap ETF. This is the Russell 2000 ETF, and for those of you guys that don't know, the Russell 2000 is a small cap index, so this simply tracks the Russell 2000. Expense ratio here is 0.1%, 1.13% dividend yield on top of that, and this is diversified across financial services, 23%, 20% in healthcare, 13% in technology, 13% in consumer discretionary, and these are all of the top businesses that this ETF owns, guys. These are the top 10. So that's pretty much it. I hope you guys found value in it, especially in this video, especially if you're a beginner. This is pretty much how I got my feet wet, along with some penny stocks. I mean, I made mistakes, guys, to be honest, but, you know, now that I have this platform, I try and tell you guys the best way to get started and to kind of learn from my mistakes. Although I did, you know, have ETFs, I did dabble with penny stocks, lost some money there, but the truth is, for the most of you guys watching this, the best way to start out is just simply buying one of these ETFs, you know, adding money into it over time, and watch your money grow, guys, because these track the best businesses out there in the United States, Canada, Asia, Europe, the whole 9 yards. So if you guys found value, hit that like button for me. Consider subscribing to the channel. And check out, like I said earlier in the video, all the free links down below in the description box if you want to be further connected with the Strive Smart community. And if you want 2 free stocks from Webull, valued up to $1,400, all you have to do is deposit $100 into that account. And that is linked right down below in the description box. So I'll catch you all in the next video. Thanks for watching. As always, stay safe out there, guys. Peace out.